Progress.
Hi there, everyone. Rob McGregor here, and welcome to On Track. It's the 30th of March, and in this episode today, we're going to talk through all the usual things. I'm recording this, as I said, 30th of March. The performance numbers at the end of February. The news is right up to date to last night. I'm recording this at 9 o'clock on the 30th of March, and the biggest news last night was inflation in Australia looks to be dropping. I'll cover off on that more. But firstly, this is for clients of McGregor Wealth Management, particularly those that use our care investment methodology and process. For everyone else, you're welcome to listen, but please get advice before acting on anything that I talk about. So what I'm going to cover today, I'm going to look at some of the latest news, particularly the news cycle. And the good news, bad news cycle we've talked about in the last few months. Put it into context as always, have a look at what the key markets have done, both in the short term and long term. There can be a tendency to get too caught up in the short term whenever there's bad news in the air, and that's a big trap for long-term returns. We're going to have a look at returns, what they're doing, what they've done, what's keeping us up at night, what's happening in shares, what's happening in property. I'm going to focus a lot during this on long-term versus short-term, because as I said, there's this real tendency to get caught up in the noise of the short-term, which always evaporates in the long-term. And people that focus too much on the short-term run the risk of making bad decisions that keep them out of the market and miss out on the long-term gains. I'm going to hypothesize on what a new normal might look like 12 months to 2 years out. Once we're over the interest rate tightening cycle. So let's get into it. The biggest news over the last month was bank failures. I'm going to put those in perspective in a minute. I'm going to talk about what they were, how many they were, what's normal, just so we can get a perspective on how important this actually is compared to how important the media wants to make it. We can see cash rates. We had another increase from the RBA. Only went up 0.25% this time, partly because of the positive. As I said last night, we had inflation falling. You can see that in the chart. That's the inflation rate falling, still well above the band. But once we start to see it falling, that builds into the next numbers over the next 12 months. So that is an indication that inflation is heading down. How quickly and how low it gets is still a mystery, but it's good news to see that falling. And we can see, inflation was right down to almost 0%, between 0 and 1. So we've had this rapid increase for all the reasons we've talked about, but it's starting to come down. 90-day bank bills up as well. So you're now getting a 90-day bank bill is just a bank investment for 90 days. You'll see similar rates for term deposits, 3.7%, quite remarkable. Government bonds dropped during the month. I'm going to talk more about that in a minute, but now 3.2%. So they're actually lower than the 90-day bank bill rate. This is a sign that the market thinks interest rates will drop in the near term. Aussie dollar pretty much unchanged, although it's bouncing around a bit. As I said, there's that inflation rate, and you can see where it's come down over the last 2 months. I've changed the number I put in here to the monthly CPI, just because we only get quarterly update on the inflation rate, so it's not much good for these videos. US inflation continuing to come down as well. Mortgage rates going up. The most rates went up by 0.25. The Macquarie variable, which we use just for some consistency, is now about 5.29. There's still one mob advertising 4.74. I don't think it'll last for long. And look at term deposits, 4.5% for 1 year term deposits are quite amazing. And the good news is for balanced investors and conservative investors, the part of the portfolio that for the last 5 years hasn't generated much return because the yields have been so low is now generating a good return. So that is a good, and I'll talk about that when I come to the new normal. In terms of the care returns, and keep in mind these are to the end of February. March will be a negative month. February was slightly negative. March will be another negative, although I do think the market's going to ramp up today of an increase in the States plus that lower inflation rate. So I do think we might close some of that gap by the time we get to the end of the month. We will see. I always like to look at the 7-year returns just to see where we're going. And you look at the numbers down here with high growth, pretty close to 9%. Growth about 8, balanced about 7, moderate about 6. And when you look at our targets, and we've used these targets for literally more than 20 years, inflation plus 3, 4, 5, 6, and they tend to come through pretty true over the long term. They can be all over the place in the short term. If we look at the 1-year returns at the moment, they're all about 0 to 1%, sometimes slightly negative, depending on exact mix of portfolios. So yeah, this is where I want to emphasise the importance of not focusing on the short term, because decisions made on short term action and short term negativity will lead to missing out on those long term increases. Let's have a talk about bank failures. And yeah, bank failures effectively happen every year. You can see in this chart, 2023, we've had 2 bank failures that spooked the market. Signature Bank in New York and Silicon Valley Bank. Silicon Valley by far the biggest one, but it was a bank that was just kind of a bad business model. They just dealt with one sector, being Silicon Valley, and particularly growing companies that have raised capital. So these companies would raise a lot of capital, they deposit the money that they raise with this bank, and then they would spend it over time. So as they need that money, and eventually, the lack of diversification by focusing on one industry, plus the fact that that industry had just been through a pretty significant downturn over the last 18 months, and that meant they can't raise as much capital. That meant they were spending their capital, led to money coming out, plus some bad investment decisions, and that bank went under. But is this unusual? Not really. Unusual was the previous 2 years where we had no bank failures. This is in the US. But in 2020, there was 4 banks failed. I don't recall any news in Australia on these at the time. In 2019, 4 banks failed. Once again, 0 news in Australia. 2017, 8 banks failed. I don't recall the news in Australia. I do recall a lot of news back in 2009 and 10, post the GFC, where we had a lot of bank failures. And keep in mind, these banks are often very small banks. The US has banks that are right down to towns and cities. Australia, we're used to big banks, particularly our big 4, but the US has literally thousands of banks. So I just want to put that into perspective. These look to be isolated. The market's been running around trying to work out whether there's any other bank failures. Credit Suisse shot itself in the foot. That's not so much a bank failure, but mismanagement. What's happened there is they went to raise some capital. They'd had a series of losses from bad decisions, particularly around their wealth management and investment banking arms. So they depleted their capital and they went to raise some capital. And part of that capital raising was to make sure there was enough money to pay bonuses to their senior bankers so they wouldn't leave. Now, this is bonuses being paid even when they weren't making money. So one of their biggest shareholders, which is one of the Arab governments, basically said no to that capital raising because they didn't want, one, they were at their limits with that bank, but 2, they didn't want to be supporting that concept. That led to some market negativity, and it led the Swiss central bank to come in and prompt them to merge with UBS, another large bank. So not really bank failure, but more bank bad management that led to a lack of market confidence. Had that happened without those other banks failing, that may not have happened. But Credit Suisse have had a bad history the last 5 years of some really bad investment decisions, so they're going to be swallowed up by UBS. And that's about where it's finished. The media's been chasing around trying to find other potential banks, trying to predict what might come next, because that's what the media does. The market's also done it. But we've seen rebounds in stock prices the last few days because the market has stopped worrying about that. And it does look like it's isolated, and it does look like it's not a trend like the GFC. There may be other bank pressures, particularly from commercial property space, where, with interest rates up, some borrowers may have trouble. We haven't had a bad debt crisis, certainly in Australia, since the 90s. We may see a rise in bad debt, but that's not likely to lead to bank failure, and no chance in Australia where banks are extremely well capitalised. So that was a big news month. Looks like that's true. I'll put that into context again around this bad news, good news cycle. So that news of those bank failures was a surprise and it was negative. So that's when markets go down. So when the news is bad and it's a surprise, that's when markets go down. So that's why the market's reacted to. Whereas other news at the moment, so inflation coming down, that news was probably better than expected, and it's good news. So it's a little bit of a surprise, which we're going to see markets go up. If the number was just as expected, we would see the markets not change too much. So once again, that news cycle, and here's where good news can be bad news and bad news can be good news as well. So things like bank failures, you go, oh, that's bad news. But then you go, oh, hang on, maybe that means the higher interest rates that have been happening are finally slowing the economy. That's going to lead to inflation. So therefore that's good news because maybe rates will pause. So good in the type of cycle we're at the moment. And once again, this is short term. So we're not traders, we're long-term investors. We look at the short term just to understand and put everything in perspective and give ourselves the confidence to hang on for the long term where we know we're going to make good money. So you get these weird occurrences where initially there's bad news, but then the market goes, oh, hang on, that's good news because they'll probably slow down the rate rises. They might even pause them. So that's good news and the market takes off. So you get this sort of weird reaction where bad news is good news. No change to the hot news topics for 2023, and there's been no real change in any of the news on those things, except that inflation, well, for now, it's stepped down. It's still a battle, don't get me wrong. No one knows, not any of us, whether this inflation will win the war in the next 6 months or whether it's going to take 2 years. I don't think it'll be as long as 2 years, but there's plenty of people that do. We'll see where that ends up. One of the biases I want to talk about today, and these are the behavioural biases that cause investors to make bad decisions because we're human beings, and we're pre-programmed to be like Neanderthal. Think our caveman ancestors. If there was a rustle in the grass or the forest, our instinct was to run. So we're hardwired that when we sense trouble, we want to fight or flight or freeze. The best thing in the market is to freeze. There's the old saying, don't just stand there, do something. In the market, it often should be don't just do something, stand there, because it's already baked into the price. But hindsight bias is an interesting one, because what it is where everyone during something going on, like right now, how long are interest rates going to stay high? How long is inflation going to stay high? There's a lot of unknown. You've got people on the negative side, people on the positive side. But wait for a year when, let's say, interest rates have dropped, inflation's dropped, everyone will say it was inevitable and that they predicted it. So it's hindsight bias. We tend to change our thoughts on it after it's all happened. And this is a trap because it leads to overconfidence, which leads us to have more confidence that we can predict what's going to happen because we think we've predicted things in the past. As I talk about often, predicting markets based on what's happening in the economy is almost impossible. And there's almost no one out there that makes a living consistently in the long run from managing money by superior economic decisions. There's a few doom merchants out there at the moment that are predicting Armageddon because we maybe are going into a slowdown or a recession. But as always, they're often arguing because it hasn't happened. When I say it hasn't happened, they've been predicting it for a while. So they're on the wrong side of their investment decisions. They kind of want the bad news to come out. So they go run around talking it up, hoping that the market absorbs it. But once again, short term, long term. The difference, we are interested in the short term, but only to assure our clients, mainly to assure our clients that this is no different from other bad news in the past, that these two shall pass and we will resume the long term. What's the long term look like? I keep updating this chart because I find it fascinating at the moment, but this is the last 20 years, and it shows almost a complete cycle where we started off 20 years ago in the wall of worry. We rapidly went into a boom. The booms are always unexpected in the early stages in particular. Then we think they're going to last forever, and then inevitably they fall off a cliff. That cliff leads us to fear, but it's an overreaction. We bounce back, and then we continue in the wall of worry, where episodic periods of fear from different random things. We've just had one on a bank crisis. So that's the next one that's up here. Fear of bank crisis, fear of bank contagion will be on there when we go forward, but the market is already starting to come back from that. So eventually there will be another boom. It will, as always, start when no one's expecting it. Could it be starting now? Possible. Can't say for sure. Won't know for 5 years. Definition of a boom for me is a market that's doubled in the previous 2 to 5 years. At the moment, the Australian share market has doubled over 9 years, which makes it exactly normal with its long-term sort of forecast. So definitely not in a boom, definitely in the wall of worry. And in the wall of worry, we want to hang on. So yeah, because most of the downturns happen most of the big downturns happen from a boom, and we make no attempt to predict what's going to happen in the short term of movements of the 5s, the 10s, the 15%, because they're impossible to predict, they're impossible to trade. And as I said, no one successfully makes a living out of trading those. There's no hedge funds around. There's nothing where anyone has done that successfully over 10 years. So sticking with the long term is by far the superior. Let's have a look at what's happening in the bond market. And in the last month, you'll see the blue line is current yield curve. So you can see 10-year bonds have dropped down about 3.3%. They were up at nearly 4%. So in the last month, they've dropped substantially. That is potentially a sign that the markets are thinking rates are going to start to drop. So we've got this interesting situation in Australia, very different in the States, where we can see short-term cash rates right up above 3%, dropping to about 3 years and then going back up, 10 years, about 3%. So at the moment, you're getting less money for, say, a 3-year sort of window of investing than you are for either 10 years or cash. So this is telling us that this is where the markets think interest rates are going, that they will drop and then steady. You can see we've come from, in the bottom corner here, this is the 10-year bond rate history, the yield. We've come down, right, bottoming below 1% in COVID. We then went up to about 4%, but it looks like we're now steady and starting to get into a range that might be between 3 or 4%. And that's kind of where we think the new normal might be, that we will have short-term oscillations between 3 and 4, but not the big trend down or the big trend up. That will remain to be seen, depending on what happens with inflation, but that's kind of what looks like it's emerging. US still is potentially thinking maybe some more interest rate rises before it falls, but that has come back over the last month as well. So also looking like that's starting to fall into that trend as well. So I think there's some positive news there. And the overall positive is that in a balanced or a diversified portfolio, you're now getting a decent return on your defensive asset. 3 to 4%, that's fair. That's what we would expect to get in the long run with low inflation. Now, we don't have low inflation yet, but if the low inflation eventuates, as it probably will over the next 6 months to 2 years, then that will keep bond returns at decent. We, in that wall of worry context, as I said before, I won't spend any more time on that, but we're quite firmly in the wall of worry. We make no attempt to predict that short term. We do make an attempt to predict where we are in the long-term cycle. We nudge that slightly above fair value on the basis there's a lot of volatility around right now. So I still think the market's pretty much fair value, but we've pushed it up a notch. All that means is for people with new money coming to the market, we're just stretching how long we take to put it in a little bit longer. So it's just an indicator that there's plenty of volatility. So we're seeing these gyrations, which you can see down here. Over the last 12 months, we've had some big dips. Then we're on the way back, but here's another dip. Looks like it's turning around. So yeah, just over fair value. Nothing to prompt any action from those in the markets. But for those averaging in, it just means we'll stretch that a bit longer. In terms of the mess it up context that we use, the two I'll focus in on this month is the short-term focus and the single issue obsession. So in that last little downturn that we had during late February and March, so we're back to here where we've come down, that was purely based off potential bank crisis. So one issue, and anything that's one issue that doesn't sort of expand generally passes over time, particularly as that issue gets cleared up. And as I said, that's why I want to put the banking failures into context. And once again, that short-term focus can lead to missing out on good long-term gains. Our care process, those returns have been really, really good. They remain in the top quartile, albeit the last year not very exciting. Slight negatives to 0 to 1 is not very exciting. We don't love that, but it's part of the process. We know that when we sign on to invest in growth investment that we're going to have negative years, and we do sit above average in those returns. Aussie shares negative for the month, but yeah, over 10 years, 7%, 8%. That means it's doubled over that period of time. But you can see with dividends reinvested, $10,000 invested in the market is worth about 24,000 over time. So yeah, a fine investment. If you put 10,000 in and left it over the last 10 years, so 23,000, we'd all consider that a great investment. So not a bad decade in what included one of the greatest drops of our time with COVID. US shares even more so. 10,000 would have grown to between 35 and 40,000, depending on which funds you're in and whether you're in the index or the category average index doing particularly well there. US shares, well, sorry, this is IOO, and yeah, it was actually up for the month in terms of about 1.57%. You'll see, just want to focus here, the US share market at the moment, or IOO, the top 100 companies in the world, the dominator at the moment, and look at the top 10 holdings, 13% in Apple, 12% in Microsoft, 5% in Amazon, 3% in Google, 6% in Google when you take the two classes of shares. So you can see it, that big tech dominates, not in the same way. So when we go back to Australian shares, for instance, we can see that our big banks and big resource companies, BHP, Rio Tinto, also dominate with numbers that are potentially higher there as well. So 10% in BHP, 7% in Commonwealth Bank, and then more banks, etc. So the big end of town does dominate a little bit, but that's the way that markets work. And most of those companies have been pretty good of late. US small caps up for the month, down since in March, and we're seeing them rebound as well, but spectacular over the last 10 years, 10,000 growing to 45,000. Emerging markets had a negative month, but ironically has had a bounce back since. The emerging market includes China, Russia, although there's no Russian stocks in at the moment, post the war. India, which we're very, very positive on as the fastest growing, youngest country in the world, and other parts of the developing world. We think they're very cheap at the moment and should give above average returns going forward. Gold has lit up in the last few months as the world was worried about a crisis, and particularly with maybe the US exchange rate was too high, but the US is the global exchange. So often, if people don't want to buy the US, but they don't really want to buy other currencies as well, they can do that switch to gold. So when we see wobbles in the world, sometimes we see these spikes in gold, which is why we have it in the portfolio. It may come off depending on the view on inflation, but certainly it was a positive. Not in February. February was actually down a little, but then it spiked quite a lot in March. So that will offset some of the other downturns, which is good. Into the property world and this cycle, the two frameworks we use for property is the property clock, where markets go through a predictable sequence of events. It's not predictable in timing, it's not predictable right down the location, but they do go through this predictable event. And we get this increase in the long run that is predominantly all done in 2 to 5 years, and then we may have 5 to 10 years of not much happening at all. I'll update you on where that's at the moment. But the main slide I want to focus in on today is the link between property prices and interest rates. So every time interest rates have gone up, not quite every time, but nearly every time interest rates have gone up, property prices have fallen. So the red line here is property prices, the average of the 8 capital cities, and you'll see one spectacular, 10 times, 11 times up since 1980. So great long-term investment if you ignore the short term, but the periods of down, which are rather small, for the most part, have all occurred when interest rates have gone up. And generally, property prices don't start to go up until interest rates start to come down. So this is a chart from AMP, from Shane Oliver, which I find very insightful. And as we start to see interest rates peak and come down, we may see property prices start to recover. Now, we still might see some more damage before that happens. The jury's out as to whether that damage has all happened or there's going to be a bit more downturn. And that'll depend on where we go with interest rates. There's a case that the RBA may pause interest rates after last inflation. They might have one more lift just to show their discipline. A pause would be good for the property market. And I believe they've done enough to slow inflation and growth. And we're going to see that impact more and more as fixed rates come off over the next 18 months for people, and they go from 2% to 5 or 6%. Net migration is very positive for property. So while interest rates are negative for property, net migration is positive. We saw net migration and population growth fall off a cliff during COVID with the borders shut, but it's back. 400,000 people came into Australia in 2022. That's contributing to the rental shortage. It also puts a cap on the property prices for us property investors, and that will continue to create good demand. Some of the other property news, we see in the top left-hand corner here, the movements in property prices, both monthly, quarterly and yearly. So over the last year, property prices in the combined capital cities down about 9.1%, Sydney highest at 13%, but Sydney's actually started to turn. And you can see that in the bottom chart here, the rate of change is starting to move the other way. And we see some positives with Sydney, with Darwin, slight positive with Perth, but still some slight negatives. Monthly figures, once again, short-term figures are kind of meaningless. And we know in the long run, from that chart before, if I go back again to charts, in the long run, this is what property prices have done. Quite spectacular. No reason not to think that's going to be the case in the future. We've just had a dip. Maybe we've got a little bit more to go. Maybe it's done. Time will tell, depending on where interest rates were. The top right-hand chart here I found fascinating. This shows what's happened to the market by the tier. So the average of the market, which is the red line, down about 10%, not quite, but 9.1. So, but when you look at the bottom end of the market, so that's lower value prices, they actually haven't moved much. So there's a lot of competition there from first home buyers. There's good rental returns. So the bottom end of the market, the bottom 25%, hasn't actually moved. Now, this is an average across Australia, so it will be different in different suburbs, but it's quite fascinating. The middle tier of the market is down about 7%, and the top end of the market, the top 25%, so more expensive properties, down about 13%. That's been consistent with my experience over 30 years as an advisor and a property investor myself, that the higher the value of the property, the more it tends to come down in a downturn, simply because there's less buyers. And the bottom end of the market tends to be fairly stable. So this is why if you're looking for stability, buying in the capital cities around that bottom to middle end of the market tends to lead to more stability. Just a reminder, the top to bottom growth from COVID. So from COVID to the peak, Sydney went up 27%, Melbourne 17%, Brisbane 42%. So when we look at those 10% downturns now compared to that, they're still above where they were pre-COVID. So the property market has done well. Obviously, costs of interest are higher. That's making it harder for investors, but rents are going up as well. So long term, I think we'll see some settling over the next 6 to 12 months. In the very short term, I don't know. There might be a bit more weakness, very hard to tell, but there might not be. If we were to see a pause from the Reserve Bank, we might see a bit more confidence in the market. There's definitely people waiting to sort of see where interest rates end up. And when people are waiting, that means it's harder to get into the market. People are less confident about getting in. Rates have done their big jump. They're starting to taper off. You can see on the fixed rates on the right-hand side, you can see they're starting to go sideways, which means the market is saying that rates are peaking. We're still seeing as the cash rate goes up, the dark blue line here, mortgage rates follow that straight up. So yeah, I'll talk about a new normal in a minute, but if we, eventually cash rates should end up somewhere around where that inflation rate is, which will be more like the 2 to 3% range. That will see mortgages come down a bit over that time. How and when that happens, can't say exactly. The property clock from our good friends at Performance Property that we use to help our clients find good quality investment property, no changes this month. We still see that cluster of small value in places like Perth as far as blue chips go, but then places like Darwin's back on that list. Some regional Queensland showing up and regional WA there. We prefer capital cities and 2-hour circle, but for those more game, there's some rural areas that like Rocky and Mackay that are showing some start of the next cycle for them. And you can see Sydney, Melbourne, Sunshine Coast, etc., all somewhere near the peak or potentially coming down there as well. What might a new normal look like? And I say this with no confidence. And when I say that, some people think that's unusual, but I mean no certainty. This will happen eventually, but I'll sort of get to the punchline a minute here. But we will get back to inflation. The Reserve Bank band is 2 to 3%. I think it might take them a bit longer to get it all the way back, but the reality is they'll probably be happy with somewhere in that 2.5 to 3.5% over the next 5 years. That might mean after the cash rate gets to, it's about 4% at the moment, 3.6, maybe it gets to 4, but then they'll probably start to drop it back to similar rates to there. That would mean bonds potentially also in that 3 to 4% range. And that would mean, shares, I've always used inflation plus 6%. Let's call inflation plus 5 to 7. That would give a medium to long-term range for shares of 7 to 10. And a balanced portfolio that is now getting 3 to 4% yields. We've always used inflation plus 4 to 5%. That would give us 6 to 7.5%, which ironically is the same as we've been using for our forecasts for 25 years. And we'll probably continue to do it because we're looking at the long term. I can never tell you what next year is going to bring. I can tell you if it's hot or cold out there, where the market's at, but we can never predict exact turning points. Hopefully you found all this helpful as usual. Thank you for your patience in listening. And finishing up as always, just on the key concepts that make us be generally good long-term investors, that all investments best done as part of a plan, which are based on goals and your own unique position. Portfolio designed to meet those goals. We do take a long-term view as much as we're interested in the short term. We talk about it in these videos. It's all about keeping us firm on the long-term view. Then we can focus on principles, which pays off in the long run: diversification, asset allocation, liquidity, low cost, protecting ourselves against the short-term volatility through 2 key strategies: reserves for our retirees and dollar cost averaging for our accumulators. And we take advantage of the short-term volatility by rebalancing regularly, which adds value over time. And as long as you avoid these 3 big ways, panic and selling, having to sell and not properly diversified, you will enjoy those long-term returns. Thank you for listening as always. And I look forward to seeing you all as you come in. And until next month, Rob McGregor signing off.